Hi, guys.
Oh, how you doing?
Not bad. How are you doing?
Doing well. So we're going from the young to the old, are we? Is that
You know, the good thing is you don't look any older than them. With the camera that's far away.
Yeah, that's a good thing.
And you know what's exciting is that, Station 2 gas is net zero.
Exactly. Yeah. Pretty happy about that.
Yeah, congratulations on a great quarter. So we've got Crew Energy here, John Leach, CFO, and Dale Shwed, President and CEO. They traded under the ticker symbol CR on the Toronto Stock Exchange and OTCQB. I don't know how people memorize those. Anyway, so if you want to touch on your quarterly success that you had drilling and what, we'll start there. And then I have some questions for you.
Okay, awesome. So there are advisories on page 36 of the presentation if anyone wants to go to that before we start, but I'll just start in here just about Crew itself. Really, I mean, we started the company coming out of Baytex in 2003, and we named it for our team that our goal is to work together, obviously, to get to a common goal amongst us all in terms of growing our production base. So that's really what we're doing. You take a look at our growth, up 20% this year, 80% in funds flow. We'll spend a lot of time on this slide, but there's a lot of points here I'd like to make, and we'll make in more detail and through the course of the presentation. I think the big thing here is that we did form a plan back in the middle of the pandemic in the summer of 2020 and looked at forward gas prices. And we just experienced 6 years of gas prices averaging around $2 an MCF. So when we saw pricing in the $3, $3.50 range, we're pretty excited about that in 2021 and into 2022. And we formulated this plan to really increase our margins by filling our facilities, our transportation commitments. And that's where we are in the second year of that plan. And we've been very successful doing that. And we'll get into how we've done it and where we're going to go from here. The big thing for us in the last little while is liquids. We put a lot of liquids on production through our UCR area, where we have a lot of condensate, as well as I think the share price is really well supported by a value proposition. Our 2P reserves at the end of last year was 1165 on the 2P basis. And that was using very, very low commodity prices. We have ample capacity to go to 40,000 BOEs. We have one of the biggest land bases in Northeast British Columbia at 260,000 plus acres. Our liquidity profile here is excellent. We just increased our bank line to 185. Don't plan on using it, but would like to have that kind of liquidity available to us. We are dedicated shareholders and bondholders. 6 of the top 10 shareholders are insiders, and we have plenty of tax pools to take us into probably past 2025 with $1.2 billion of tax pools. And there's a snapshot of our capital structure. On the next page, just you asked about the Q1. These are the highlights of Q1. Our production was up 27% from last year, same period, to 33,400 BOEs. Op costs were down quite nicely by 25%. And that was one of our goals, as I stated earlier, to decrease our cost structure down to 350. AFF for cash flow is about $78 million or 48 cents a share. It's a big increase of 129% from the prior year. Our free cash flow was about $22.3 million. Of CapEx through the quarter is about $55 million. And we completed 6 wells and drilled 5. And you can see the graph on the bottom here. And funds flow is up quite nicely quarter over quarter and has been going up since. We would expect Q2 to be better than Q1 based off of pricing. And you can see our costs coming down with time. On the next page, just take a quick look at the fundamentals of gas. I probably don't need to go into this a whole bunch, but we're very bullish on gas in the future. And you can see really on the far right, even renewables have a steady incline, but not to the same extent in the growth of natural gas or petroleum and other liquids. And that's an IEA study. So very bullish on hydrocarbons going forward in terms of providing the world with its energy needs. And I think we've seen indications of what's going on all over the world, more recently, specifically around shortages in Europe and elsewhere, and obviously the unfortunate war between the Ukraine and Russia. And on the bottom right, really, we are into another super trend, as you can see here. Usually these things last about 10 years, and we're just coming out of a down cycle. and hopefully into a nice upcycle for energy, which is clearly supported by the fundamentals, as I just stated. So let's take a look at our growth plan, and I'll flip through these fairly quickly. When we started the plan, we were in 2020, we averaged around 22,000 BOEs a day. Last year, we averaged 26,400. This year will be between 31 and 33,000. In Q1 of this last year, or this year, we were at 33.4 thousand BOEs. And really that's the goal here, is get to that 31 to 33 this year. And then over the next few years, fill our capacity up to that 40,000 BOEs, as I stated. This is what we also stated in that plan. We want to reduce our cash costs by around 25%. There's the components, operating costs down about 30%, transportation 25%, G&A 10%, and interest by 30%. And you can see in Q1, we hit that goal at $9.61, which is in the midpoint of our $9 to $10 range that we estimated 2 years ago. And next on our AFF, lots of changes here, specifically around where commodity prices are, much better than what we had projected. We're going to be in that sort of $245 to $265 million this year, and that's using fairly conservative prices at $85 WTI. And $5 NYMEX gas prices. So we think there's room for upside in those numbers. And even with those numbers, it should throw off around $150 to $185 million of free cash flow. And our uses for that free cash flow would be to reduce our debt. We want to pay down our bank line to zero, and then apply the rest of the funds to reducing further debt or growing the production base. So it's the leverage metrics, again, from a DOE perspective, nicely down to 11,700 in this quarter. And from a debt to EBITDA basis, last 12 months, we're ahead of target right now. In Q1, we're 2 times. And by year end, we plan on being around 1 times, as you can see here. So definitely deleveraging is the plan, and we continue to focus on that. And this is next page is really just a synopsis of what you just saw over the last 2 years, from 20 to 21 and 20 to 22. I think the big changes here, and what we're very happy about, is the production per share growth every year is around 20%. And the costs are coming down to the extent this year by about 21%, even though we are seeing inflationary costs in the industry. Our costs are coming down. Cash flow is up quite significantly this year, up about 92% from what we did last year, and so is the AFF per share, up about 88%. So very happy with what we're doing from a debt deleveraging perspective, growing the production base as well, and increasing cash flows. Let's take a look at the Montney resource itself. Here's a map of most of the shale basins in North America. One thing I will say about the Montney, it's not a shale. It's more of a siltstone sandstone sequence. As a result of that, it can store quite a bit more hydrocarbons than a shale, and it does act more like a tight conventional reservoir. So the declines that we have on our more mature production is around 11%. So very easy to replace that, clearly. So once you've got a lot of your production on and those facilities filled, it doesn't take much to keep those facilities full, and that's kind of the general rule with the plant. In terms of the inventory, you can see there's a number of different thicknesses of the Montney on our land base. You can go anywhere from 500 to 600 feet to over 1,000 feet in thickness. We have up to 5 different zones that we plan on developing, and you can see that we mostly developed the land around West Septimus and Septimus, with 109 and 87 wells drilled in those 2 areas. And really, it's only because that's where our facilities and infrastructure is currently located. So what we try to do is optimize all of that in those areas. But we're very, very enthused about some of the upside that we have at Attachie, at GROUNDBIRCH, as well as West Portage and Tower. And you can see the number of locations on the bottom there that we have in each of those areas. On the next page, this is a new slide in the presentation, really illustrating our land base in a different perspective, as well as our land, the well control that we have on our land. And obviously, we're very well connected here with the 3 pipelines, the TransCanada system, the Alliance system, and the Enbridge system. We're connected to all 3 of those systems. We're also literally a stone's throw away from the connection at the TC meter station that's going to take gas to the Coastal Gas Link pipeline, which is going to take them to LNG Canada. So we're very well positioned from a land perspective, as well as a pipeline perspective to connect into that as to be a potential source for gas for any of the proponents that are in that project. More recently, this is some of the things we've been doing operationally. You can see here, this is at the Greater Septimus area. There's a well log on the right. You can see we just recently completed the 414 pad. That's 10 wells, 421 pad, 5 wells. These wells now are paying out in under 6 months. Newer wells are, just because of the condensate content we've got in them. In addition, some of the older wells that we've had in here are paid out in 300 plus days, 330 days. Some are paid out in just over 200 days. So very happy with our capital allocation in this area, and very excited about some of the results that we've had with those recent wells, illustrating much higher condensate rates that we can now take and drill further east. And I will remind the viewers that we do have quite a bit of land east of where we've cut this map off, so we continue to go in that direction. Next page, just illustrating how good those wells are. On the left, that's the 414 pad. That's 3 wells to the east. We have the most production on right now after 75 days. You can see here they've been on averaging about 2,100 BOEs a day, 600 barrels a day condensate, and 8.4 million a day gas. On the right, these wells, by the way, were about 4,140 meters average lateral length, so quite long. And then the ones on the right were about 2,700 meters, and that's average 110 days on now there, 16 BOE a day. And you can see the 5.8 million a day gas and the 282 barrels of condensate average in those. So very robust. And more importantly, what we have booked in our reserve report is the dotted line that you see below the actual production. So quite a bit ahead of the type curve that was booked. So happy about that as well. The next page, this is an area that we've been recently more active in. This is called GROUNDBIRCH, and we actually drilled the 3 wells there that you see on the map to hold land. We actually held around 55 sections of land with the drilling of those wells. When we drilled the pilot well, we were very excited about what we saw in the logs, and decided to drill the 3 wells off to the west. On the right, you can see the productivity of those wells averaging right now, IP 180, about 8.6 million cubic feet a day. And again, there's the type curve that we have in the area. So it's far exceeding what we have booked. And what we like to see is that flattening out of that production curve as we continue on in the production lives, which is what we're seeing here, which is, in our view, very positive. So what we're doing now is we have 5 wells from that pad that we've drilled to the west. And those wells are planned to be completed in July and then put on production. We have plenty of pipeline capacity in here to take this gas to our Septimus gas plant and also to our West Septimus gas plant, so we can split the flows to either plant. In the future, we do have plans to build a plant in this area at GROUNDBIRCH. We have a lot of land, 70,000 acres of land. You can see by the big yellow block there that there's a lot of drilling to do on that land. And draw your attention to that one pad down to the south. It's about a mile off our land. As we go south, those 2 A wells, the double A wells, which we feel are probably the most prospective zones in the area. But we are drilling 3 other zones in these other wells to delineate future development in the area. Those wells have been on for about 6 months now at an average of 12 million cubic feet a day. So very robust production from those wells. Just draw your attention. This updated this slide. I think it's quite interesting. The fact that I alluded to earlier, we had 6 years of $2 gas, and that's illustrated on the left by the blue line. That's AECO pricing, and we did take some of our gas to Chicago, so we had a better price in the pink that you can see there. Updated it to Q1 22, and you can see just in Q1. That we've cash flowed. We spent more money there as we should have, as we put those UCR wells on production. And I think Q2 will be a telltale, and we'll have a lot less capital spent there and much more cash flow. Nevertheless, what this shows you is that when commodity does not support development, we don't spend it in these areas. And so what we did is we took cash flow, you can see in 2016 to 20 out of that area, and deployed it into the West Septimus area where there were more liquids. And you can see on the far right now that we are 42,000 million cubic feet a day just in the first quarter, how we've ramped that production up very quickly once we had price signals to do so. And we will continue to do that up to where it's got the capacity is around 60 million cubic feet a day. Next slide, just a very quick snapshot of our hedging. We're just around 45 to 50% hedged this year. Falls off to much less than that. Next year, we're around 22,000 GJs hedged for next year at the moment. Condensate there, we don't really hedge much going forward. The strip only supports roughly 6 months of that type of hedging. And so we have a lot exposed to the current market, which has been very robust. And we still have quite a bit exposed to the different markets that you see here, the Station 2 floating, ATP, which is on the Alliance pipeline, then some Dawn floating, and also some Chicago floating as well. I will draw your attention also to the fact that our gas, because we have a lot of liquids in it, is very hot, and it sells at a premium to benchmark pricing. We get about a 22% premium to whatever posted price you'll see on a daily basis. On a value proposition, you can see here, there's a lot of numbers on here, but I will say one thing to you, and probably most important is if you look to the graph on the right, which was the commodity prices used in our price deck when we had these reserves run by our engineers. The lower pink line that was used in the engineering report, which is the dotted line, is now about over $5. So it's a $2 improvement for 2023 on gas prices on the strip. And we're over $1 improvement in 2024. So whatever you see here for an MPV has been increased quite significantly since these numbers were done. Nevertheless, we still have about $11.65 2P number for our reserves. That does not include any land value. As everyone's aware, Montney land typically sells for that sort of $1,000 to over $5,000 an acre. And I would say a lot of ours is in the higher end in terms of what we've been able to prove up, specifically around GROUNDBIRCH. So I think there's a lot of value to backstop the share price of the company here. This is on page 24, just looking at history, and what we're doing here is reducing our costs. And that's really a function of one thing, most importantly, is we're drilling 2-mile laterals now versus 1-mile laterals. So we're getting much bigger bang for our dollar when we spend it. And as a result, the costs are coming down. And on the right, you can see, importantly, our reserve life index on a 1P basis is 18 years, on a PDP basis is 7 years, and on 2P is 35 years. So lots of running room on the existing reserves we have booked. And if you look at the next page, these are the reserves we have booked on our land base. And I will remind you that a lot of those lines that you see are only one zone developments. So there's a number of different zones that we can develop either above and below what has already been booked. So you can see there's a lot of yellow land there left to be unbooked. As a matter of fact, we only have 19% of our land that's currently booked. And that includes, if we were to develop one zone, that's included in that number that has been booked already. So lots left. And then, we have had a history of buying assets and selling assets when we felt that we could deploy capital in better environments. And that's exactly what we've done. We've now sold over $725 million of assets over the course of time, redeployed it, very happy with our position in the Montney. We don't need to be buying anything in the Montney, as I just illustrated, that we have a massive land base there, infrastructure to support growth as well. So we do have an option, continue to have an option to sell another 22% interest in our gas, another 11.4% interest in our gas plant at West SEPTIMUS for $37.5 million. And that comes due in June of 2023. Lots of liquidity, as I pointed out in the first slide. On an ESG basis, very happy where we started and where we're going. You can see here, we have been rising to the challenge of reducing greenhouse gas emissions. And you can see we're down 50% from 2020 to where we're projecting to be in 2022. And you can see our peers in our peer group, we're now the fourth lowest intensity out of the group. So again, this is something that we're focused on and we'll continue to focus on. As well, from other parts of the ESG spectrum, you can see we're 57% down on water, freshwater usage, 76% down on gas plant flaring, and reportable spills are down by 73%. One of the things we're very, very proud of, we're the first company in Canada to bring this technology into Canada. We got it out of Germany. It's a Kevlar pipeline, and it's spoolable that we can transfer water from sea rings or other places on surface for completion operations. And just in one operation at our 332 pad that we used it on, we took off the equivalent of 7,300 two-way trucks from hauling that water from one location to another, which was the equivalent of about 146,000 kilometers, or 4 times the circumference of the globe in truck traffic, which related to about 329 tons of CO2 equivalent. But that's just the beginning in terms of what this does for us. One of the biggest things in our business around safety, and that's something that we really focus on as a company, and I believe as an industry we do it as well. But this is very important to crew. And what this has allowed us to do is take trucks off the road, and most of the accidents that happen in the oil industry are traffic accidents for the most part. So it allowed us to reduce that quite significantly. Obviously, if you don't have 7,300 trucks on the road, you're gonna have a lot less chance for either spills and or people getting hurt. One of the things we are also focused on is governance, and we have 6 board members, of which 2 are, and I'm obviously one of them, who is in management. So we have 40% outside management of our board that are female, represented by females. Then the last page, again, just a summary from what I talked about initially. And with that, we can easily take some questions.
You were so fast, Dale. You were so fast.
How much time did I take? I don't even know. 15 minutes. Wow.
I've never heard you go that fast before. Anyway.
Is any questions? Happy to answer.
I have a few. I hope I can fill 15 minutes worth.
Sure.
I think it's on your first or second page, just the sensitivity you have to gas. At least it was in your last presentation, sensitivity gas prices for every 10-cent change. Yeah.
It's on page 34 of the presentation.
Are you talking that, or
you're talking
this slide here?
That one?
Is that what you're looking at?
Yeah, that's the one I'm looking at.
Okay.
Yeah. I mean, with your low CapEx and with the amount of free cash flow you have, and potentially even more free cash flow, given what's happening in the natural gas market, do you see a bump in CapEx coming?
Well, I think, as I pointed out to you, our number one priority is to pay down our debt. And I think once we have, very clear visibility to getting where we want to be, and I think overall, this year our goal was to pay off our bank debt, which was, I think at the end of this last quarter was about $93 million. That's including working capital. So if we can pay that off, we would look at reducing debt a little bit more than that. Obviously, we have to refi our bonds between now and in March of 24, and we'd probably like to do that in the next year. So that's something else we're looking at. But if we continue to pay that down, we'll probably look at refining a lower number in terms of the $300 million that we currently have outstanding. So we'd like to pay down our debt more than the bank debt that we currently have, and then at the same time also look at increasing our CapEx to obviously get to our 40,000 BOEs that we have capacity for. But as to the timing of that, it's going to be 100% dependent on where the cash flow is coming from.
Okay. Now on that 40,000 BOE a day facility, how much more should your netbacks increase given a static gas price?
Yeah, so our fixed costs are around $1 to $1.50 BOE. Mm-hmm. So that would give you an indication is if we increase the production from where we are, what the potential upside could be. But it would be fairly significant.
Mm-hmm. Mm-hmm. So obviously it would be nice to get to that 40 sooner rather than later if you could.
It would.
Yeah. Hedging wise, we already touched on that. Now, do you find that with the success you've had with the UC wells and now what you've had at GROUNDBIRCH, you're seeing new interest from investors? Like, I don't think, a lot of people grasp how big your land position is and how prospective it is. And you've only proved up quite a bit, but there's still a lot more to prove up. So are you getting a lot more interest and as you're having these great wells?
I would say that we haven't. It's kind of funny. When we released our quarter, it was the best quarter we've ever had. Highest production, highest cash flow. And our share price was down 13% on the back of it. So I'm not. We can't. I don't know. In terms of what the investor base is looking at. I think what we're trying to do is just look at the basics of the company and take care of the things we say we're going to do, which is obviously the 2-year plan that we're obviously engaged in and really ahead of schedule on the plan. And then keep with the plan going to the 40,000 BOEs. So we're just focused on that. And I think eventually, we'll get recognized for some of the execution that we're been successful on.
Well, knowing you guys as long as I have, this is the best asset base you've had in the 20 plus years I've known you. I think even going better than the Baytex days for sure. And it seems strange that you're not getting as much traction as I think you should as other players in the area. I guess if you keep putting up the numbers, it'll just take care of itself.
Yeah, I don't think it's just a crew thing at all. I think it's more an industry issue, just with attracting new investors, and obviously, the ESG influence on investing has impacted, I think, the level of interest in the industry. Having said that, I also believe from a macro perspective that the world is starting to see the importance of what we do and the security that we supply the world in terms of being able to use energy. I think once that sort of hits home, there likely will be more interest in it, and they'll be looking for out of the groups or greener companies. And we showed you a slide there that we're the number 4 on that list in terms of emissions. So we hope to hopefully rise closer to the top. Obviously, when you look at things from that perspective, but like I said, the thing is for us, we just have to continue to execute, and usually good things happen when you do that.
Yeah, I think you're right. I wasn't meaning to necessarily single out you, but I just look at all your opportunities but you're right. The whole sector is trying to get multiples we've never seen before, given where commodity prices are. And, what we're going through as far as the overall market, it reminds me a lot of what happened when the tech bubble burst. And then we headed into a huge commodity run for a number of years afterwards. But that said, in the money, I think there's money starting to flow out of ESG funds, et cetera. But again, we still don't have that same investor base that would go to resources naturally. What do you think from the audience? In your opinion, what's the best hedging strategy for CREW given its opportunity, strengths, and ongoing debt reduction?
So what we try to do is we try to hedge about 40% of our production going into the forward year. And we try to do that by about 10% each quarter. And that's been fairly prescribed. And we've been doing that for a number of years now. So there's no magic to it. It's more prescribed. It's more formulaic. And, obviously you're going to have some years you're going to hedging gains and some years you're going to have hedging losses. And I can tell you right now, we've had a lot of hedging losses from our hedge book that we did back in August of 2020. So, but you have to be disciplined. And I think one of the biggest things that we see is that if we have a capital program, and you know how quickly things can change in this business, is we have a capital program that we're going to say we're going to spend X number of millions of dollars. We want to make sure we get a good return on that investment. So as a result, we would probably hedge whatever volumes we have coming on when those wells come on to ensure that we get that rate of return. And that's what we've been doing. And that's what we did with this program. And it's worked. Yes, we have left some money on the table on the hedging front, but we've also protected the company as well and our investment in specific projects. So that's really the philosophy around it.
Okay, perfect. Thank you. I have some other questions, but I'll give you guys a call later if that's okay with you, because we have now run out of time, which I can't believe. Yeah. I know. I can't
just started.
I know. I'll give you guys a call later on if that works for you.
You bet.
Okay. Thanks so much.
And thanks for the invitation, everybody in Adelaide. Appreciate it.
Okay. We really appreciate you taking the time.
Take care.
Thank you.